The global economy in May 2025 presents a complex picture for investors and policymakers alike. While some indicators suggest resilience, others point towards persistent headwinds and underlying fragilities. Global GDP growth forecasts offer a somewhat muddled view. S&P Global projects a conservative 2.2% expansion for 2025, whereas the International Monetary Fund anticipates a slightly more robust 2.8%. Adding another layer, UNCTAD has projected a slowdown to 2.3%. A significant concern clouding this outlook is the escalating global public debt, which is on a trajectory to climb by an additional 2.8% of global GDP this year. This trend could see total global public debt approaching the critical threshold of 100% of GDP by the decade's end, limiting fiscal policy space for many nations, and potentially heightening financial stability risks across the interconnected global system, demanding careful monitoring. Focusing on the United States, the economic narrative remains one of careful observation and measured expectations. The first quarter of 2025 saw an unexpected contraction of 0.3% on an annualized basis, a development largely attributed to a significant surge in imports. However, beneath this headline figure, domestic consumption and business investment spending demonstrated encouraging solidity, suggesting some underlying strength. Looking ahead, growth forecasts for the current second quarter stand at a modest 1.5%, with the full year 2025 projection hovering around 1.4% according to Reuters, while the IMF offers a slightly more optimistic 1.8%. Encouragingly, the perceived probability of a U.S. recession has declined to 35% from 45% in April, offering a sliver of optimism amidst broader concerns over slumping consumer sentiment and subdued business expectations. The Federal Reserve's policy stance continues to be a central focal point for global markets as it navigates persistent inflationary pressures. The federal funds rate has been maintained within a 4.25% to 4.50% range since the beginning of 2025, reflecting a cautious approach. Inflationary pressures are proving stubborn, with expectations that U.S. inflation will average above the Federal Reserve's 2% target until at least 2027. This persistence fuels ongoing debates among economists regarding the timing of potential rate cuts. Some analysts anticipate possible easing in the third or fourth quarter of 2025, but the elevated U.S. federal deficit levels exert considerable pressure on the Fed, potentially compelling it to maintain higher interest rates for an extended period to anchor inflation expectations effectively. A fireside chat with Federal Reserve Bank presidents later today is eagerly awaited for further insights. The fiscal health of the United States also remains a prominent topic of discussion and concern within financial circles. Debates continue to swirl around the long-term implications of President Trump's tax cut bill and its impact on government revenues and debt accumulation. Compounding these concerns, a recent credit rating downgrade by Moody's has further sharpened the focus on the nation's fiscal sustainability. On a more positive note, U.S.-China trade relations have seen a temporary reprieve. A recent agreement, effective May 12, 2025, involves a mutual reduction in tariffs by 115 percentage points for at least 90 days. This truce has certainly eased immediate global trade tensions, yet underlying risks in this critical bilateral relationship have diminished but certainly not disappeared entirely, warranting ongoing vigilance from market participants. Across the Atlantic, the United Kingdom's economy is grappling with its own set of challenges, particularly concerning inflation and consumer activity. Market participants are keenly awaiting the April retail sales figures, which are anticipated to show a month-over-month increase of 0.4%. This expected rise is reportedly driven by stronger performance in the durable goods and clothing segments, potentially indicating some resilience in consumer spending despite broader economic pressures. However, a significant hurdle for the UK economy is the persistent nature of inflation. Price growth remains stubbornly above the 3% mark, a level that continues to exert considerable pressure on the Bank of England and its monetary policy path, making future interest rate decisions particularly critical for economic stability. Meanwhile, in Asia, Japan's economic landscape has been stirred by recent inflation data. The Core Consumer Price Index (CPI) for April delivered an upside surprise, registering a 2.9% year-over-year increase. This figure exceeded market expectations and has intensified speculation that the Bank of Japan (BOJ) might be compelled to implement another rate hike in the near future. The primary motivation for such a move would be to provide support for the struggling Japanese yen, which has faced significant downward pressure. Despite the higher inflation reading, which typically might bolster a currency, the yen weakened further post-announcement, touching 157.60 per US dollar, highlighting the complex dynamics at play for Japanese monetary authorities and the challenges they face. Turning to U.S. equity markets, the S&P 500 index experienced a period of consolidation, ending the week relatively flat after navigating through considerable volatility. Investor sentiment remained cautious, largely influenced by rising concerns over U.S. fiscal risk and its potential implications for broader market stability and corporate earnings. In contrast, the Nasdaq Composite managed to post modest gains, with its performance primarily buoyed by the strength of mega-cap technology stocks. Notably, the technology and artificial intelligence sectors demonstrated resilience, leading a minor rebound in the S&P 500 after an earlier dip in the week, underscoring the continued investor interest and perceived growth potential within these innovative segments of the market despite wider uncertainties. European and Asian equity markets presented a somewhat more positive picture during the recent trading sessions. European bourses edged slightly higher as expectations regarding interest rate trajectories began to stabilize. This was partly supported by signals from European Central Bank officials suggesting a potential pause in their cycle of rate hikes, offering some relief to investors. Across Asia, markets were predominantly in the green. Investors in the region were actively digesting Japan's latest inflation figures and contemplating the pace of China's ongoing, albeit slow, economic recovery. China's Mixed Purchasing Managers Index, PMI data, and persistent weakness in its crucial property sector, however, continue to weigh on overall sentiment, even as S&P Global revised China's growth forecast upwards due to policy stimulus, contrasting with WEF sources cutting it to 4%. The foreign exchange markets continue to reflect a landscape shaped by economic uncertainties and shifting monetary policy expectations. The US dollar maintains its dominant position across the board, a testament to persistent safe haven demand amidst a complex global economic environment. Investors are seeking stability, and the dollar often serves as a refuge during times of ambiguity or stress. Conversely, the Japanese yen has experienced further weakening, particularly after the release of Japan's higher-than-expected CPI data, which saw it reach 157.60 per dollar. Interestingly, S&P Global has noted that a broader trend of US dollar depreciation, should it materialize more consistently, coupled with improving global inflation prospects, could point towards more accommodative global financial conditions in the medium term. The cryptocurrency market has been a hive of activity, marked by significant milestones for its leading assets. Bitcoin (BTC) surged to a new all-time high, breaking decisively above the $110,000 level. This impressive rally is reportedly fueled by substantial institutional inflows, indicating growing acceptance and integration of Bitcoin within traditional finance portfolios. Furthermore, the continued momentum of Bitcoin exchange-traded funds, ETFs, has played a crucial role in broadening investor access and driving demand. Alongside Bitcoin, Ethereum, ETH, also achieved a significant breakthrough, surpassing the $6,000 mark. This upward movement for Ethereum is largely supported by the expanding ecosystem of decentralized physical infrastructure networks, DePIN, and the increasing adoption of Layer 2 scaling solutions, enhancing its utility and appeal. Beyond the established giants of the crypto world, the market also witnessed the debut of PiCoin, a newer entrant that has garnered considerable retail interest. Its listing was met with a flurry of trading activity, reflecting enthusiasm among a segment of individual investors. However, market analysts have broadly advised caution regarding PiCoin's long-term viability, particularly concerning its underlying utility and tokenomics, which remain subjects of scrutiny. The initial reception for PiCoin has been mixed, highlighting the speculative nature often associated with newly listed digital assets. Investors are encouraged to conduct thorough due diligence before engaging with such ventures, especially given the inherent volatility and evolving regulatory landscape of the broader cryptocurrency space. In the commodity sphere, key assets like gold and oil have been navigating a period of consolidation, influenced by mixed macroeconomic signals and anticipation of future policy decisions. Gold, ZAW USD, is currently trading near the $2,430 per ounce level, finding it challenging to decisively break through key resistance points. Many investors continue to view the precious metal as a crucial hedge against uncertainties, particularly those stemming from concerns over U.S. debt levels and broader fiscal stability. Meanwhile, West Texas Intermediate (WTI) crude oil is holding its ground above $78 per barrel. Market participants in the oil sector are closely monitoring U.S. inventory data for demand cues and are keenly awaiting the upcoming OPEC Plus meeting scheduled for next week, which could provide direction on future production levels. Both gold and oil remained largely range-bound over the past week. Shifting focus to specific regional markets, Dubai's real estate sector continues to demonstrate remarkable dynamism and growth. In the first quarter of 2025, property transactions in the Emirates surged by an impressive 23% year-over-year. This growth was particularly pronounced in the villa segment, where sales soared by an extraordinary 65%, indicating strong demand for larger premium residential properties. Despite this robust activity, analysts are forecasting that the Dubai real estate market may reach its peak pricing level sometime in 2025, after which a period of stabilization is anticipated. The market is also witnessing a significant influx of new off-plan launches, particularly flooding the premium segment, which could influence price dynamics and absorption rates in the coming months. Beyond transaction volumes, technological innovation is also reshaping the Dubai real estate landscape. Blockchain technology is increasingly being integrated into the market, fundamentally altering traditional ownership models through the concept of tokenization. This innovative approach allows for the creation of digital tokens representing fractional ownership in real estate assets. Such tokenization not only enables a broader base of investors to participate through fractional investing, but also significantly boosts liquidity within the property market. By making real estate assets more divisible and tradable, blockchain is unlocking new avenues for investment and capital formation in one of the world's most vibrant property hubs, fostering greater market efficiency and accessibility for a wider range of participants. On the geopolitical front, there have been some encouraging developments that have contributed to a slight easing of global tensions, though underlying fragilities persist. In the Middle East, a U.S. Houthi ceasefire, mediated by Oman, is currently in place. This development is a positive step towards de-escalation in a volatile region. However, it is important to note that Houthi forces reportedly remain hostile towards Israel, a stance that continues to pose a risk of regional tensions flaring up. Nevertheless, overall tensions in the Middle East appear to have eased somewhat, with discussions around the potential for longer and more comprehensive ceasefires offering a glimmer of hope. Similarly, in South Asia, India and Pakistan have reached a new ceasefire accord following a period of heightened cross-border tensions that lasted for 3 weeks, a move welcomed by markets. For investors navigating this complex global environment as of May 2025, a cautious and well-diversified approach remains paramount. Close monitoring of signals from major central banks, including the Federal Reserve, the Bank of Japan, and the Bank of England, will be crucial for anticipating shifts in monetary policy and their market impact. While the technology and artificial intelligence sectors continue to show potential for growth, investors should remain mindful of their inherent volatility. The strength in Dubai's property market is notable, but the potential for it nearing a peak suggests careful consideration for new investments. The recent easing of geopolitical tensions in the Middle East and South Asia is a positive development, but the situation remains delicate. Consequently, safe haven demand for assets like the US dollar and gold is likely to persist amidst ongoing global economic and political uncertainties.